Banking is one of the most powerful forces in the modern world. Yet for most people, it feels like a sealed room with no windows. Why does banking use a language that seems familiar, yet never quite reveals what it means? Why do major financial institutions operate behind closed doors? And why does a tiny group understand the system completely, while the rest of society understands almost nothing at all? Today we're going to make this clear. No jargon, no speculation, just structure, incentives, and institutions, exactly the way historian Carroll Quigley analyzed civilizations. By the end of this video, you'll understand how money is actually created, why bankers use ambiguous terminology, why powerful banks operate privately, how the financial system is structured, and why this creates a permanent knowledge gap between financial elites and the public. Let's begin. Section 1. Why banking feels confusing. Modern banking speaks a language that looks familiar, but hides complexity, and this is the first source of confusion. The same word describes completely different things. Take the word deposit. Most people imagine it simply means money you put into the bank, but in banking there are actually two meanings. 1. Lodged deposits, your paycheck, your savings, cash placed into the bank. 2. Created deposits. This is something entirely different. It's the money a bank creates when it issues a loan. When you receive a mortgage or a business loan, the bank does not hand you someone else's money. It simply writes new numbers into your account. Those numbers become new money circulating through the economy. Both are called deposits, but they are not the same. Lodged deposits come from you. Created deposits come from the bank's ability to expand credit. They look identical on a bank statement, but inside the system, they behave in completely different ways. This is one example of how financial language creates confusion, not because it is deceptive, but because it is not intuitively clear. Section 2. Why powerful banks operate in private? Historically, the world's most influential banks were not corporations. They were private partnerships, sometimes not even formally incorporated. This structure created several advantages. Advantage number 1, privacy. Private banks do not have to publish financial statements, reveal strategies, disclose partners, report profits, or advertise. They can act quickly and quietly. Advantage number 2, control, no outside shareholders, no quarterly earnings pressure, no public scrutiny. Decisions stay within a small circle of partners, and banking decisions often rely on sensitive political information, advanced knowledge of government policy, confidential corporate negotiations, foreign exchange movements. The more public a bank becomes, the less flexible it is. Advantage number 3, stability. Partners risk their own capital. Losses are personal. This creates discipline and discourages reckless speculation. Why does this matter? Because Quigley argued that financial networks maintain power through information speed, expertise, and strategic privacy. Private structures preserve all of these, not because of sinister intentions, but because this structure survives most effectively inside modern finance. Section 3 on the 3 layers of modern finance. To understand global finance, imagine 3 rings orbiting a center. This is Quigley's core periphery model. Core layer, private investment banks. This is the financial nerve center. These institutions buy and sell government bonds, arrange international loans, manage foreign exchange, oversee corporate mergers, influence global money flows. They do not deal with the public. They deal with governments, multinational corporations, and other banks. Secondary layer, commercial banks. This is the bridge between the financial core and everyday life. Commercial banks hold deposits, extend credit, process payments, create most of the money supply. When the economic cycle expands or contracts, this is usually the layer where it happens. Outer layer, savings banks, insurance companies, trust firms. These institutions collect money from millions of people. Retirement contributions, insurance premiums, long-term savings trust funds. Their role is to channel money inward, from the public to commercial banks to the investment banking core. And this structure explains something important. Financial knowledge becomes concentrated at the center, while financial responsibility is spread across the outer layers. Section 4. How central banks and governments shape the system. Now let's look at the tools used to guide the flow of credit. Central banks have two primary tools. Tool number 1, the discount rate. This is the interest rate central banks charge commercial banks. It sets the cost of borrowing. Raise the rate arrow borrowing slows lower. The rate arrow borrowing accelerates. Tool number 2, reserve requirements. This determines how much cash banks must hold. Low reserves leads to more credit creation. High reserves leads to less. These tools do not act directly on the public. They act on commercial banks, which then transmit the effects to the economy. Governments have two primary tools. Tool number 1, public spending. This injects money into the economy, funding infrastructure, programs, and employment. Tool number 2, taxation. This withdraws money and adjusts incentives. Central banks and governments act independently, but constantly influence each other. Governments rely on bankers to issue bonds, stabilize currencies, manage crises, and advise on debt. This interdependence is a major theme in Quigley's work. Section 5. Why banker advice often conflicts with public needs. This may be the most important idea. Bankers, governments, and industries want different outcomes, so their recommendations often conflict. Bankers prioritize protecting capital, minimizing risk, maintaining liquidity, ensuring debts are repaid. Governments prioritize public welfare, economic stability, political survival. Industries prioritize production, innovation, employment. These goals rarely align perfectly, so banker advice may not benefit workers, taxpayers, small businesses, or long-term national development. This isn't malicious. It's simply a structural mismatch in incentives. Quigley argued that when one group controls credit, the lifeblood of a civilization, it naturally gains disproportionate influence, not through conspiracy, but through dependence. Section 6. How this fits into Quigley's civilizational theory. In a civilization's early stages, finance is an instrument of expansion. It fuels exploration, innovation, and growth. But in later stages, the financial system becomes rigid, more self-protective, less transparent, less aligned with public interest. These are the markers of what Quigley called the age of conflict: ambiguous language, private structures, concentrated expertise, widening distance between elites and the public. These are not accidents. They are the natural evolution of institutions as civilizations age. When institutions stop adapting, they begin serving themselves, and that is the signal that reform is necessary, or decline accelerates. Conclusion. Let's bring all of this together. Banking feels mysterious because its language hides complexity. It operates privately, and expertise is concentrated in a narrow core. The system has three layers: investment banks at the center, commercial banks in the middle, savings and insurance institutions on the outside. Central banks and governments guide the flow of credit, but depend on bankers to keep the system functioning. And because their incentives differ, conflict naturally appears. Quigley teaches us that this is typical of late-stage civilizations. It is not about good people or bad people. It is about institutions evolving and eventually becoming rigid. And once you see the structure clearly, the world stops feeling confusing and starts becoming understandable. Thank you for watching.